Well, welcome to a special episode of Talking Markets. I'm Jeremy Schwartz, Global CIO at WisdomTree. We're filling in for Maggie today. I've got Jim Bianco. Jim, welcome to Talking Markets.
Thanks for having me. Looking forward to the conversation.
This is my first fill-in role for Maggie here on Talking Markets. We do our own podcast, Behind the Markets, that people might also hear this on. But Jim, we've known each other for 7 or 8 years. We've got to get to work together on a very interesting project where you're running an index, and WisdomTree launched an ETF, WTBN, tied to your Bianco Total Return Index. I want to talk about how you're positioning, but before we get into just how the bottom line of what are you telling bond investors to think about through your index, give us your current state of the world. What are the key macro? Give us your top line view.
Yeah, so the current state of the world is it's frozen because all the data has now been put on hiatus until the government shutdown's over. But beyond that, I think the biggest question we have to ask is, what is the state of the real economy? I think as far as the inflation goes, let me attack that first. It is elevated. It is, core inflation is around 2.93%. It's not near the Fed's target. Even the Fed is now saying it's going to take 2 years for their target, for inflation to get to their target, if that even happens in 2 years. In other words, it's not going to happen anytime soon. But I think the real economy is the question. And the real question there is, what is the state of the labor market? Because what we've seen is a dramatic slowdown in the number of jobs created in the United States in the last 3 or 4 months. There's no doubt that the numbers are slowing. But the big question we need to ask is, how many jobs do we need to create? That's a real dilemma. Now, the number of jobs we need to create comes from two things: productivity growth in the United States and population growth in the United States. And of those two, population growth is the more important, or the bigger influence on it. Since Trump became president, closed the border, has now been very aggressive with deportations, we have seen net immigration in the United States, and I'll use the Congressional Budget Office's estimate, go from an estimate in January that we would have 2.7 million new entrants in the United States via immigration, 2.7 million more entering than leaving. That was their January estimate, to 408,000, which is what their revised September estimate was. So 83% of their estimate disappeared. And of those 408,000, about 300,000 of them came in the first 3 months of this year. In other words, net immigration is practically zero. What does that mean? The population growth of the country is the lowest we've seen in about 80 years. You got to go back to the 1940s, 1950s to find the last time the population growth was this low in the country. So what's that lead to for the economy? August is the last payroll report we had. We created 22,000 jobs. 29,000 on a 3-month basis. Jay Powell himself at his September press conference said the break-even rate, the number of jobs we need because of that fall in immigration, might be between 0 and 50,000, with an average of 25,000. So here's the real question. All economists are looking at this number, 22,000 in August, 29,000, saying, historically, this is a terrible number. It has fallen from 140, 150,000 a year ago. This must mean the economy is falling off a cliff. And that's not an incorrect assumption, except when you start to look at the dramatic decline, 83% of what we thought were going to come into the country in terms of net population or net immigration is not happening. And what Powell said, we only need 25,000 jobs a month. And that's a hard thing for people to get their head around. So these job numbers might be okay. And then if they are okay, we're just not used to it, and you've got elevated inflation, the risk is the Fed goes too aggressive on cutting rates and goes too far into easy territory, and that might spark more inflation.
Yeah, we'll get into what we think. There's been a lot of discussion with Stephen Miran joining the board of what is neutral. We'll get to that. Maybe we'll come back to that in a second. But you mentioned sort of GDP growth is how many people are working, how productive are those people? Where are you? The other big story for the markets and the macro clearly is AI. You can't get away from just talking about AI. Now, where is that in productivity? What do you think? Are we going to start seeing layoffs? Because is it just a no hire, no fire program? What kind of anecdata / macro data do you have on this AI impacting productivity?
Yeah, so two things about this. First of all, the build out, the data center hyperscaler build out is adding about 1.25% to 1.5% of GDP. The CapEx expectations over the next couple of years are over $1 trillion, and that also includes the energy usage as well. So those numbers to build out AI is so big, it's showing up in GDP. We've looked at the data back, to the 1950s and said, has there ever been a sector, a build out of a particular sector industry that has been so large that you could see it in the overall GDP numbers? And the answer is no, it really hasn't happened. So that's at one level, it's helping the immediate economy right now. Now, the next question is, what are we going to do with all this AI? I come back to a statement or a line that Bill Gates said in the late 1990s about the internet. And what he said was over the next 1 to 3 years, it's going to underdeliver on what you think. And over the next 10 years, it's going to overdeliver on what you think. And that's exactly what the internet did when you go back to about 2000. All the we were all going to be buying stuff online and there would be no more brick and mortar retailers. Well, that was right 15 years later. It didn't happen in 2002. Yeah. And I feel that that's the way that the AI is going to go. All of the we're going to lose 100 million jobs. It's a new Senate report that came out earlier this week. That might be correct over a longer period of time than we think. So not immediate payback on AI, with the exception of being coding. There is definitely a huge increase of productivity in coding. And so you don't need to hire as many programmers to do the same amount of work. But now that I've said that, I want to then pivot to a friend of mine who's a professor at Northwestern University, Bob Gordon, in the economics department. He wrote a book in 2015 about technological advances. I mean, looked at like the Industrial Revolution, the inventing of the printing press, all the way to the internet. And I'll summarize what he was saying is that whenever you have a big, increase of productivity or new technology, it is in the long run a net creator of jobs. So we hear all these bellicose headlines. Oh, it's going to lose 60 million jobs or 100 million jobs. And as I said, it might be true, but it's probably going to create more than 100 million new jobs over that same period. Now, the problem is I can point to the jobs that get displaced, think driver, automated cars and stuff like that. I can't tell you what the jobs are that are going to be created because those are in industries that don't exist. And the reason that those industries don't exist is the business models are not profitable yet until AI comes. If you want an example of this, I've seen this meme going around on social media that says, 25 years ago, so basically 2000, we didn't have, and they listed Facebook and Google and Amazon, and Amazon Prime and streaming services and on and on and on and on and on. And when you look at all of the things that we have, or the iPhone and everything else, you then start to realize these are tens and tens of millions of jobs in a bunch of industries that didn't exist 25 years ago because of the invention of the internet. I think AI is going to be the same way. And the reason you're going to get those new jobs is AI is going to change business models. And I'll go back to my one last example. If we get rid of the driver in cars, delivery trucks, taxis and everything else, the cost of transportation will go down. It will go down quite a bit. It'll be cheaper to take a taxi to go somewhere. It'll be cheaper to deliver something. That will change business models that are currently not economic to being economic and create whole industries around the idea that you have cheaper transportation. That's just one of many examples that you would look at. So it will create jobs, and it will probably create more jobs than it will displace. But I'll come back to what I said earlier. I can point to the jobs that get displaced. The jobs that are being created are kind of a conceptual, ephemeral thing. And since I can't tell you exactly what the job is that's going to be created and where do I go to apply for it, everybody gets afraid of technology because they only see the jobs that are being lost. They don't see the jobs that could eventually be created.
That's what makes this inflation, the long-term inflation discussion, so hard, is because you got elements, and this is like you could talk through your long-term inflation thesis. It's like you've got some elements that are very pro-inflation being sticky for longer, and then you've got this impact of AI, which you gave the coding example, but there's things that are making things more productive, which are a little bit deflationary. So how do you weigh the balance between the sticky inflation thesis and AI is going to make things much more productive and be less inflationary?
I think that the AI thing will become a deflationary, pull several years from now as it becomes more mainstream and more ubiquitous in the way that we do our jobs and in the way that we live our lives, kind of like the internet is now. It's part of the way we live our life. Asking a normal modern person to disconnect from the internet is asking them to try to remove their right arm. It's almost impossible to do it at this point. But we're not quite there yet when it comes to AI. But I ultimately think we are going to get there. It's just going to take a little bit more. Now, in the inflation part, there's a couple of things going on. I'll back up. I use this line all the time. I like to say that every time there's a recession or financial crisis, the economy changes. It's shocked. And coming out of that shock, it's a little bit different. I didn't say dystopian. I didn't say it's worse. It's different. And part of the difference that we've seen in the post-COVID economy is remote work. I'll give you one statistic. Nick Bloom over at Stanford University has done a lot of work on this, and they estimated that people that were working remotely, let me give you a definition, you get paid to do your job not in an office, a hospital, a school, or a site. You get paid to do your job away from a central location at least 1 day a week. That's remote work. Work from home is all 5 days. 7% of the workforce was working remotely in 2019. Today, it's 27% of the workforce. That has been a tectonic change on the labor market. It has put more power in the hands of the worker versus management. Workers can demand a lot more now because they're now got a lot more options. Look, you don't want to pay me. I don't like this job. I don't like my boss. I quit. I could get another job without having to move. And so that gives them a lot more power to demand certain things. And we've seen that in sticky wages. If you look at the Atlanta Fed wage tracker or some of the other numbers, we're running consistently around 3-ish or so percent wage growth. So that's one. The other one is deglobalization. A new phrase to me in the last couple of months is, what is the opposite of deglobalization? It's segmentation. And so we're starting to see the global economy start to segment a lot more. And then, of course, there's immigration patterns. It's not just the U.S. that first had a huge influx of immigrants and then closed the border. It's every developed country in the world. From Australia to Europe to the United States and Canada, we're seeing this immigration pattern being repeated everywhere. These are big tectonic changes in the post-COVID economy. And I think what they've done is whatever efficiencies we had because of the internet, because of technology going into 2020, have been somewhat offset by these. And that's why we have this sticky inflation. I like to make sure that everybody understands. When I say I'm worried about inflation, I'm saying 3-ish% inflation, not 8-10 Zimbabwe inflation. I don't think we're going to see anything like that. But why is 3 important? Because if we're talking about interest rates, where should the Fed be doing? How many more rate cuts should they be doing? If 3 is the baseline for inflation, they might be done or should be done cutting rates then at this point. And if they keep going, they might wind up going too easy and overstimulate an economy.
Well, I guess that gets into this whole Steve Miran debate: is what is normal, what is neutral? Miran, maybe, from your view, Miran, there was some quotes in Wall Street Journal that set you off over the weekend. Maybe give some views of what's going on inside the Fed circles of, what Miran is saying. Now, it's interesting because you had this groupthink at the Fed where everybody was consensus. There's no dissent. It's refreshing that you're getting some dissent and debate in my view.
Yeah. Oh, absolutely. I think that, I've been in an unusual situation on social media where I've been defending Miran. I think he's great that he's at the Fed. He's got heterodox views, but I don't agree with any of them. But that doesn't matter. I mean, they need this kind of other viewpoint. The problem with the Fed, as you pointed out, was groupthink. The last vote in September was an 11-1 vote. And I'll point out to everybody, the Fed puts out this dot plot every quarter where everybody tells you where they think the funds rate or the inflation rate is going to be at the end of various years and the long-term rate. Why do we need that dot plot? Why do they need to put that out? Because they don't allow dissent. Look at the Bank of England. They don't put out a dot plot. They had a meeting in August. They had to have a second vote to cut rates, and the vote was 4-4-1. 4 to cut 25, 4 to not cut, 1 to cut 50, and so they wound up cutting 25. There's a lot of information in, if to use Fed term, forward guidance in a second vote being 4-4-1. So it kind of tells you what's coming next for the Bank of England. That's your forward guidance. But when you engineer every meeting to be 12-0, 11-1, occasionally a 10-2, there's no information in that. So they try to augment that with the dot plot. So I think if they were to just let everybody speak their mind, tell us what they think, disagree, that would be the forward guidance. Miran might be the beginning of that because he is now a heterodox voice. My complaint was another voice there, the New York Fed president, John Williams, criticized him and was criticizing him for the way that he was approaching it. And he was saying that there was problems with his methodology. And I said, that's fine, but I've never heard you say that about anybody else at the Fed. You know, that somebody else has a viewpoint, and you've never given a speech saying that this other Fed governor or Fed president is wrong in their thinking. You're coming down on him because he's in the temple. He's not an orthodox viewpoint, and therefore you feel very threatened by him. And that is where I went off on him about on social media, was that they can't stand that kind of view. And then I went on to say, the other problem with the Fed is that there's no accountability at the Fed. So if they do certain things or certain things happen, where are we supposed to be worried about them? And I'll be very blunt with the one that I was very critical of. In 2019, August of 2019, the former New York Fed president, Bill Dudley, wrote an op-ed in Bloomberg, on Bloomberg, not the Wall Street Journal. And he was very critical of Trump. Now, I know why, because the previous week was the Fed Jackson Hole conference, and Trump put out this very scurrilous tweet where he said, who's worse for America, Chairman Powell or Chairman Xi? That was not called for by Trump. But I understand that got Dudley upset. And he wrote this scathing op-ed where he said, the Fed has the power to affect the election. We can tank the economy, and we can make sure that Trump doesn't win. Holy crap. That is J6 level type of an accusation. Now, the Fed came out and distanced themselves from them. But what they said was, trust us, we won't do that. And my comment was, but you have the ability to do that. And there's no check on that ability to do that, other than we're supposed to trust you not to do it. So these are the types of unaccountabilities that the Fed has that they need to address, and they need to be more forward thinking. I'd like to know from the Fed, what is the procedure, if there is one possible, that you won't ever decide to do that. And, that brings in the rate cuts of 50 basis points in September of last year before the election. How does that not fit into that framework? Or that brings into Lael Brainerd, who was the vice chairman of the Fed in 2016. When the Fed raised rates in December of 2015, they didn't raise rates again until after the 2016 election. During that period, Lael Brainerd was a leading voice to say we need to hold on raising rates. She was donating to Hillary Clinton's campaign. She was on the short list to be the Treasury Secretary. Sounds like a conflict of interest. Now, I'm open to the idea that it's not. But explain to me how you weren't using your position at the Fed to engender one candidate to win over the other so that you could then get a promotion to being Treasury Secretary. Tell me why. And the problem with the Fed is they don't even have to answer the question. Just pretend like it didn't happen. Look the other way. Everybody will stop asking questions about it, and it'll disappear. And that's where I get worried about with the accountability at the Fed.
Yeah, there's all this discussion with Trump about Fed independence, and even that is a magical guaranteed thing to be independent since it was a creation by Congress. And it's like, so, they got to be careful what they wish for in some ways. But, is independence there a magical thing? Like, is there other countries, like I think of Japan, where you have Japan where it's not so independent, but you've got a sort of new election there that's going to make their policy quite interesting, actually. But what do you think about this sort of Fed independence question?
Well, I think, first of all, independence is kind of a continuum, right? It's not a binary. It's not you're independent or you're not. It's how independent do you want to be, and how independent should you be? And that gets back to the whole accountability thing. If you want to be independent, we have 14-year terms for Fed governors. Every 2 years a term comes up. They're supposed to be insulated from the political pressures because they have their own budget at the Fed. The Fed's not shut down for the government because there's no government budget that needs to be approved for the Fed, so they keep operating. Okay, that's fine. That's independence. But where is the accountability, the check that I was just talking about? And that's really what's sorely lacking with the Fed. Now, the Fed could do it themselves, but they don't elect to do it themselves right now. I worry some about independence for the moment because I feel like every time a pendulum swings, it always goes too far in one direction. Where we have Brainerd basically, donating to a candidate and then saying we can't raise rates because I need this candidate to win. All right, that's my accusation. I'd love to hear the argument from the Fed that wasn't the case. And maybe it swings back too far the other way, towards, more that the Fed becomes another political entity like the Treasury Secretary is or the Commerce Secretary is, that the Fed chairman becomes that. And what I fear there is what Donald Trump has been saying. He says that he wants the Fed to aggressively cut rates because he says if they do, all interest rates will fall. That's a debatable proposition, whether or not long-term rates would follow short-term rates lower. But let's assume they do. Then we could refinance the debt of the United States at lower interest rates, and the interest cost would come down. That's fiscal dominance, is what that argument is. The problem with that argument is, if that did happen, that we swung the pendulum all the way the other way and Trump put in a chairman and everybody agreed with him, we got to cut rates to 1% and make all the interest costs lower. When can we ever raise rates again? And the answer is never. You would never raise rates again because it would increase the cost. And the only time you'd be forced to do it is basically when markets hyperventilate that inflation is getting too high, you're not addressing it, so we have to then be the bond market vigilantes or the stock market vigilantes and address it by lowering the valuations in markets. That's the fear, that's the risk you have, is that for those, and I hear a lot of people say, no, they have to cut rates because the debt, we spend over $1 trillion a year in interest costs. Sure. How do you ever raise rates again? And by the way, the argument is it's not the Fed's job to fix that $1 trillion in interest costs. It's Congress's job. Congress has approved the $38 trillion of debt on its way to 40. And so they've caused it, not the Fed through interest rate policy.
Well, the only way people have ever solved these debt issues is they inflate it away. So there's this inflation question of you got to raise your GDP, but you got to keep your costs manageable. Let's talk about the yield curve for a second, because we talk with Siegel every week on Behind the Markets. He's very much of the view that this sort of flat curve is not normal, and usually it's only during like recessions or a strange thing to have a flat or inverted curve that we had for a while, and we had a very inverted curve when the Fed was too tight. Now. Or arguably, Siegel would say it was too tight. Maybe you would disagree. But he would like them to be 100 basis points below the 10-year. That you should have a normal, last 70 years, the normal term premium between Fed funds and the 10-year was 100 basis points. So if you say the 10-year is right, you got this cabal of central bankers controlling the short-term rate. Who knows if it's the right rate or not? He would like to go from this ample reserve regime to a scarce reserve regime when you used to get a daily signal on, was the Fed too tight or too loose? You don't get this daily signal anymore. And so who knows what the right short-term rate is? They used to get a signal before QE in 2008. Now you don't have any signal. And so let's say, the 10-year is more quote unquote market moving. If you say the 10-year is right, we should be 100 basis points below on that worldview. Any thoughts on the yield curve and that line of argument?
Yeah, no, I agree with a lot of that. I mean, for bigger picture, there's a famous line about that when a measure becomes a target, it stops being a measure. Meaning that when you target an interest rate like the Fed does with short-term interest rates, there's very little informational value about the state of the economy because it's set by a committee. It's not the market trying to signal to you. Long-term interest rates are the market trying to signal to you right now. I agree with Dr. Siegel that the yield curve has It used to be this perfect indicator before COVID, right? 8 for 8. 8 times it inverted, 8 times we had a recession. Then it inverted for 2+ years, uninverted, and it's still very flat. I agree with that. But we never had a recession since 2020. So the yield curve has ceased being that indicator that we think. Now, I would argue that maybe it's being too overly managed. And that's why you're starting to see the yield curve not be that indicator. I notice I used 8 for 8. The last 8 recessions, it's predicted all of them. The 8th one, the furthest one out, was back in 1969. In the 50s and the 60s, the yield curve was not a good indicator for recessions because we had Operation Twist. We were in the Fed and the Treasury were intentionally trying to set both long-term and short-term rates. They were managed rates, administered rates by committees, so the informational value was very low, and therefore it didn't signal a recession. When the rates were freely traded, especially after the 1970s, when we kind of opened it up after Regulation Q, which allowed interest rates to float a little bit more, they became more of an informational value. And I'm afraid that maybe we're starting to see that happen now. I agree with Dr. Siegel that long-term, the 2-year, 10-year spread has been, I've calculated 98 basis points, call it 100. It's 100 basis points that when things settle down and go back to the way that they have been historically, the 10-year note should trade 1 full percentage point above the 2-year note. It's not anywhere near that. Now the question becomes, which one is the 10-year right and all the short-term rates should go lower, or is the 10-year or the short-term interest rates roughly in the right position and the 10-year rate should go up? I would argue the latter, that the 10-year rate should go up because, as I said earlier, if I'm in a 3% inflationary world, even if it called 2.5 to 3, and there's the thing that the Fed calls R star, okay, the inflation rate's 2.5 to 3, how much above the inflation rate is the neutral rate? They estimated it around 1%. I'll go with that for argument's sake. So that means that the neutral funds rate is around 3.5 to 4. We're at 4 right now. So we're pretty much neutral-ish right now. So I would argue that maybe short-term rates are about where they should be and long-term rates are a little too low.
So that might get into how you're thinking about positioning your index for sort of thinking about the best guy. Maybe give people a sense. Why did you even get in the index creation business? What did you think about it? How's it gone as an index manager since you started this project?
Yeah, so we started the project, and so everybody knows we manage a discretionary index called the Bianco Research Total Return Fixed Income Index. That's a mouthful. If you have a Bloomberg, it's BTRINDX, or BiancoAdvisors.com is a website that shows you about our index. We meet monthly at a minimum, sometimes more, and we set the parameters on our index. Where do we want to be relative to a benchmark, like on our duration and on the shape of the yield curve and on credit and on mortgages or structured notes and what we call conviction bets? Do we have some out-of-index bets? Now, currently, and before I go on to the index, you, our partners at WisdomTree, have an ETF, WTBN, that tracks our index. If you wanted the analogy I've used, think of the S&P Index Committee, sets the S&P 500, and then the S&P Index Tracker Funds track that index. We set the parameters of the index, and WTBN tracks our index. Currently, we are 90% of our benchmark duration, meaning we're short duration, meaning that we're less sensitive to interest rates. Why? Because if they go up and prices go down, we don't want to go down as much. We are currently in a bulleted position, meaning that we are overweighted in the 5 to 10 year sector, underweighted less than 5, underweighted longer than 10. So we're in this bulleted position. Why? Because that's the way your portfolio will perform better if the yield curve steepens. So I think that with the short duration, if the long-term rates go up and short-term rates are kind of held steady because the Fed's still talking about cutting rates, and we're not going to get any data to change that, so they're going to cut rates, that the yield curve should steepen. We have been we've been underweight corporate bonds. That's not been a good trade. Corporate bonds have performed very well. They're at generational tights. The last time the corporate bond index was this narrow over comparable treasuries was 28 years ago. So they've been performing very well, but we've been underweight that. But fortunately, if you're underweight something, you have to be overweight something else. We've been overweight mortgages, and they've performed okay. And what I mean by okay is most of the underperformance loss that we've had with corporates, we've made up almost all of it with mortgages. Now, we've been better off being the other way around, underweight mortgages, overweight treasuries, but this has not been catastrophic. Now, why have we been underweight corporates? Because if you look at corporate spreads overlaid with the stock market, it's kind of the same thing. And I've argued that our weighting is what we think of the stock market. And given the high valuations of the stock market and given the opportunities elsewhere, meaning structured or mortgages, I would rather take my risk with mortgages. And, it's been a slight negative right now. And then finally, we have got these conviction bets away from our basic investment grade index. The first one is we own a position in local currency emerging market debt. Why? Two things. It yields 6.8%. Love to have it yield 6.8%. Love that big fat yield. And it benefits if the dollar has been declining. We've been in that position for most of the year, and it's worked out fairly well. The other position is in TIPS, Treasury Inflation Protected Securities, from 0 to 5 years, not longer term. And that would be that would benefit from an increase of inflation expectation, and that's worked out fairly well too. In the year ending in September, our index has outperformed the Bloomberg aggregate, to use one measure, by about 1% or about 100 basis points.
So that's it seems like a good experience. It's just interesting that you've gone with this approach of, there's ETFs that can get you exposure. You don't have to do a lot of single security selection, but you can get a very broad cross section by making these big calls of the big levers, from duration to credit to mortgages to these things like the out of conviction. And how have you found that experience? Like, what do you think about that setup?
Well, so two things about the setup. The first one is the way that we structure our index is through using other ETFs. And it's really quite easy to say we would like to be everything I described: short duration, this on the yield curve, this with corporates, this with mortgages, and we could do that with a dozen ETFs. Now, let me contrast us to the big fixed income ETF BND, which is BlackRock's index that tracks the Bloomberg aggregate. It has 18,000 securities in it. Most of those securities are mortgage securities, by the way, and there's a couple of thousand corporate bonds in there and a few hundred treasuries as well. 18,000 securities. I could do the same thing with 10 to 15 ETFs. The liquidity, the ease, the less frictions of having to set up an organization or anything like that to do it with all of these securities is made it much easier and much more straightforward, just like every ETF is done pretty much for everybody else. So we do it with ETFs. That's been, something I didn't think going into it. I thought it would be kind of constricting only using ETFs. It's not. The other thing I learned was we decided to go, because we're an index, with a monthly meeting. And occasionally we will have a meeting inter-month. We've done, I think, 2 of them in the 2+ years that we've been doing this. If circumstances change, the last one was right after the election in 2024. So what does that mean? That means I like to say, look, we have to think as the committee. I'm the head of the committee. We have to think, where do we think we want to be positioned for the next 6 months, 12 months, 18 months? And once we set that meeting and those positioning, whatever the payroll report is or the CPI report is or whatever red headline comes across the Bloomberg is what it is. I can't do anything about it. Can't lose sleep about it. So don't worry about it. I thought going into this, that would be constricting. Oh my God, I got to put these positions on the week before the payroll report. And what is the payroll report? It's been liberating because I've been looking through all that noise. I don't get an ulcer and, staring at the screen 12 hours a day, chasing the last 5 basis points in the market. And so having this index approach and having this less is more when it comes to this process. And I'd say to any professional manager that is listening to me, look at your turnover, and I'd say what I've learned is less is more. And that, don't get yourself all bent out of shape about having to position 20 minutes before an economic release and then having to unwind it an hour after the economic release. If you're doing that, you might have to ask yourself if you're over trading, and are you really adding value or just churning your money?
Yeah, that's a very interesting perspective. You've seen ETFs get used by a lot of different people, and here you've got really a very interesting, call it fixed income, go anywhere, that with guardrails, in terms of how do you think about what levers you're going to pull to outperform the broad index. But you and I were on the road after the Super Bowl, and you talked about your sort of 4, 5, 6 framework for markets, thinking stocks were going to do well, that the cash was yielding 4, bonds were going to do 5, stocks are 6. I was pushing you to 6 to 7, but maybe now they're closer to 6 in my view. Where how are you on thinking about this high level 4, 5, 6 framework? Are you still there? Is that
Yes. So one thing real quick is that you and I were on the road right after the Super Bowl, and you were in your Saquon Barkley jersey during that because the Eagles won the Super Bowl, and congratulations again. Hope to not have it repeated because I'm not an Eagles fan.
Looking strong besides for this week, but
yes, exactly. Strong. You guys are looking very strong. I've been arguing that over the next several years that the financial markets, we're going to return 4, 5, 6, 4% cash. And that's largely what they've done. Even with the Fed rate cut, it looks like you're going to get 4-ish% cash because the funds rate's still at 4. Bonds would return 5. They've done a little better than that. If you look at the Bloomberg Aggregate Index, that's the big investment grade index that everybody uses, kind of the S&P 500 of the bond market. That's actually been a little bit closer to the high 5s to 6%, but let's just 5%-ish is where they are. But the big one is the 6% on stocks. That I've argued that with the high valuations in the stock market, that your expectations should go down. So to be clear on this, stocks, valuation is not a timing tool. Just because the market's richly valued or overvalued, whichever word you want to use, doesn't mean it has to go down. What it means is that over the next several years, unless something extraordinary happens, usually the market disappoints because it can't, the companies disappoint that they can't meet these lofty earnings expectations, and the market flattens out on its returns. And that's been the 6 in the stock market. Now, 2 things about the stock market. It's up 14% this year, the S&P. But, and I'll quote Michael Kemblis at JP Morgan on this, that's where I got it from. ChatGPT came online November 29th, 2022. Since that day, 70% of the gain in the S&P has been what JP Morgan identifies as the AI and AI-related stocks. 41 of them have accounted for 70% of the gain. The other 459 stocks in the S&P are 30% of the gain. And if you actually look at what those other 459 stocks have done, they're pretty close to 6%. And then you tack on to it the big gains with the Palantirs and the NVIDIAs of the world, and that's where the market has had these outsized gains. And as an adjunct to this, I've been writing about this lately, is that 2 other things that have happened is those 41 stocks are now 47% of the S&P 500. So half the S&P 500 is AI or AI-related stocks. So it really calls into question the diversification you're going to get. And interestingly, I put this out yesterday on social media. The top 8 stocks in the S&P and the top 8 stocks in the NASDAQ 100, the QQQ index underlying it, are the same 8 stocks. That's never happened before. And so all of a sudden now, the AI thing has gotten so far that you've kind of merging the NASDAQ 100 and the S&P 500 kind of into being kind of the same index. The NASDAQ 100 would be just a higher beta version or a higher levered version of it. So those stocks have been running, but the rest of the market is more around 6. I've been arguing that for investors looking over the next several years, those are not bad returns, 4, 5, 6. But the problem is people get all kind of frowny face about it because it's not 20. I'm used to it always being 20, the stock market going up. That's what it owes me or owes us. And crypto's supposed to be up 100 every year. Well, those are outsized gains. And we've had a series of outsized gains. And now maybe we're going to kind of, trend back towards the mean. Notice I didn't say the stock market is going to crash or it's going to have a bear market. There's a lot of ways you can arrive at that 6% number over long term. It could go down a lot next year and give you a big negative and then average out to 6. Or it could just slow down to give you kind of mid-single digit returns for a long period of time, and you would average out to that 6 as well.
Yeah, so the debate people have all the time is like, where in the AI, quote unquote, I'm going to definitely put in quote unquote bubble are you? And like, how early in the bubble formation are you? Or is it continue to go? We've talked about that with Professor Siegel all the time of, he called big cap tech stocks the suckers bet of March of 2000. How much of this rhymes? You'd say Tesla is the one stock that really has a triple digit PE. The others are in the 30s, and there's debate on each one of them of like, what's their, growth profile versus their valuation. But it's an interesting, you got Dylan Patel on Patrick O'Shaughnessy's podcast that we're in throwing the first pitch, Jim. You're going to a Cubs game today. They're about to throw the first pitch of where is AI. So it's, you got all these debates of where you are in the cycle.
Yeah. So a couple of things about the first pitch. That might be correct for what AI means for society and what it means for businesses. But it's the job of markets to be in the 5th, 6th, or 7th inning of discounting that first pitch before it happens. The markets don't wait for that pitch and then discount it. So they've been discounting it for a number of years. I think that the rhyme, when Dr. Siegel, and I remember that while talking about, the suckers bet with big cap tech, the rhyme that I see with AI is, if you look at AI, and Goldman Sachs came out literally the day we're recording and said, the AI stocks are, richly valued, but they're not really at silly valuations. There's a couple, Palantir and Tesla and a few others that are at silly valuations, but the others like Hewlett Packard are not. And so therefore they said it's okay. But I think really what is missing there is that if you look at people like Sam Altman, Jeff Bezos, David Solomon of Goldman Sachs, Roger McNamee of Elevation Partners, and I picked those names because in the last week, they've all come out and they've all warned that AI is a bubble. And what I've heard them say, which I think reminds me of 2000, is the bubble isn't that these stocks are at insane valuations, with a couple of exceptions. They mostly are not. The bubble is not every AI stock can win. And the market is pricing every single one of them as a winner. It did that in 2000 with the internet. Not everybody's going to win. We had the pets.coms of the world when that busted, but we priced every single internet stock as if it was a winner. And then when the peak comes, we then sort it out and say, here's all the losers. They lose 80 or 90% of their value. But the winners don't go up a whole lot more because they've already priced in being won. And that's when the market trades off. So the concern is not that the valuations in general are overdone. It's that not everybody can win. And then we price everybody as if they're going to win. Might remember December of 99, January of 2000. Here's somebody put .com in their name and their stock price tripled overnight. Why? They're not going to be a winner just because they're in the internet, but we priced everybody like that. And that's what I see now that looks to be a little worrisome.
Well, Jim, it's always great talking to you. And so it's great to be back here on both Talking Markets. Hopefully people on Behind the Markets also get to hear this. Thanks for joining me on this special episode.
Thank you. I enjoyed it.